Okay, yippee. It doesn't seem to have crashed the meeting after recording start. Alright, so hope everybody can still see my screen and hear me clearly and there are no bugs on your side. Alright, so with that, let's jump into the Alright, so let's jump into the next part of our part one. 2 days back, we did the session on the global indices. I hope you found that useful. Some of you did provide some feedback. Thank you very much for that. Others, please think about any inputs that you would like. Also, I'm trying to learn a little bit of digital stuff. I'm supposed to say and request everyone to subscribe to the channel and press that bell icon wherever it is so that you get updates and notifications, and also the number of subscribers of the YouTube channel grows. So if you've not subscribed, please subscribe, and if you refer anyone, request you to ask them to subscribe. So, all right. With that, what we're going to do in today's webinar is specifically look just only at the Nifty and the sectoral indices. So it's just a follow through of the global indices discussion that we had 2 days back. In case you missed it, the webinar is public and available on the IMR playlist. Please do review that. All right, so you should be able to see the Nifty on your screen right now. And what we basically have is the daily chart of the Nifty, right? And this is updated till yesterday, obviously. All right. So if you look at the long-term picture in the weekly time frame, basically what happened in the Nifty is we fell off a rising wedge in hindsight textbook classical pattern, not as defined and refined, but if you want, that's actually how the 2008 crash also began. There was a rising wedge here, which is actually far better to visualize. Let me just go back just to reinforce. Right, where are we? Yeah, there we are. Right. So the 2008-9 crash happened with the rising wedge, which is a lot better defined here than the one that we had right now. The one we had right now is really, testing analysis, nerves, and patience. But all right, and yeah, if nothing else, you will remember it for any time in the future that you see it. So that's a rising wedge of the end of 2007, and that's how the 2008 crash happened. We had this big fall for about 3 weeks, then we had this tremendous recovery, and then we had a small sideways movement, and then we went down and we had lower tops, lower bottoms, and well, as I say, the rest is history. We went down all the way to 2,252. So from 6,400 to 2,252. So that's a quick recap of the 2008 crash. In a sense, what we have now is this fall and this recovery, and still lower tops and lower bottoms are probably more likely to happen, and that will obviously pan out in time. Right now, obviously, this looks dramatically and vastly different. Yes, it is, because even if I zoom out, this doesn't really look like a rising wedge like the 2008 one, but trust me, it is. You can go back and review your low theory charts. Actually, the rising wedge is this, not that. Right? This is after the breakout, so that looked more like a parallelogram or a channel. This was the rising wedge, which was broken decisively on that day. Right. All right, and this fall is obviously bigger and sharper than the 2008 fall. The first part of the fall. If you look at the first part of the 2008 fall, it's much smaller than this. The recovery, however, is started, and we are definitely in some sort of a bounce. Even if you look at the volumes, this is weekly chart, mind you, you can see that the volumes on the recovery are clearly much lower than the ones on the fall, right? And that's typical of what is called a dead cat bounce. So that's what's going on right now. Coming to the daily chart, what's happened is you've got one, two, at least higher top, higher bottom formation. Also breaking out of some intermediate term moving averages. And if you look at it closely in terms of volume, some volume pickup has happened, though there's been a big volume, right? Not big, but relatively same volume on Monday. Today, Tuesday is a holiday, right? But that volume is a little significant. Now, with what is there on the indicators, MACD, RSI, stochastic, etc., it's possible that this up move is not completely over. And something Ravi was mentioning just before we started the webinar is you can also look at things from an Elliot Wave perspective. So I'm just going to do a very quick basic review. Not sure how many of us here know Elliot Wave, but anyhow, all said and done. So there are different counts, as they are called, and alternate counts of any pattern, any wave that is there, according to Elliot Wave theory itself. So that makes it a little bit of a challenge as to which count is the one that is accurate. I'm not going to get too much into the details of that and just keep it as crisp as possible right now. But one of the most likely counts is 5 wave down. So that's where it started, starting with 0, 1, 2. And we've got definitely a tremendously extended third wave, right? And when I say a tremendously extended third wave is, right, so 1, 2, right. So you see that even at 3.618, this or 361%, it's gone here. But if I were to change some parameters and make that 5, right? So it went almost, or rather beyond 5.618x of the initial 0 to 2 move. And that's definitely, by any standard, highly extended third wave. Tends to happen in very dramatic moves, either up or down, and this is clearly a dramatic move down. So we've got that, and this in turn should have 5 internal waves. So this is probably 1, 2, and a big 3. Now the debate is actually, 1, 2. This is the 3 till here, and then we had a 4 just till here, and then this is a 5, right? And this would be the internal waves of wave 3. So wave 3 is, in a sense, where did it go? Yeah, so this is where 3 has possibly ended, right? And the internal counts of 3 are, this could be 1, 2, right? Or this is 1 of 3, 2 of 3, this whole thing. This whole thing is the 3 of 3, and then that's just the 4 of 3, and then the 5 of 3 comes here. And then, so this is wave 3, right? Now, assuming this is wave 3, so to make it very clear, we're going to put a question mark, because we are assuming it's the wave 3, right? We don't know it's a wave 3, but likely to be the wave 3 given the structure, the count, the gaps, the extensions, etc. So this is 3, and then we need to get a 4 wave. A 4th wave is a reaction to the 3rd wave, which can have various patterns. It can have what is called a zigzag, it can be a flat, it can be a triangle, and some various versions or variations of that, rather not versions, variations of that. It can also be what is called a complex correction, which is a combination of various corrective patterns. Now at this point, this looks like you can never really be sure, this looks like a zigzag wave, right? And a zigzag is typically consisting of 3 subwaves, A, B, C. So this could be an A, this could be a B, and that could be a C. Now the thing about the ABC pattern is that the C tends to have a certain ratio to the A, right? And if that's the A, that's the B, right? And we are saying the C, at least a 1x of the wave A would need to make the market go to 9,570, 9,550, thereabouts. And in the unlikely possibility that we get an extended wave C, right, you can't rule out 10,500. That's also a possibility. There's also an intermediate possibility of, let's say, where is this? Okay. Okay. Let me make this one. And, all right. Right. So these are some Fibonacci based Elliot wave based projections, which may or may not happen. Right. There needs to be a certain internal structure to all these things. Since this is only on the daily, and on this I don't have internal pictures, I'm not going to get into it. And besides, I don't want to make this an Elliot wave discussion. Not too many people are comfortable with it. So, but anyhow, so if this is the ABC, this is the A, this is the B, right, and that's the C. So anywhere to, you know, these levels, 7,250, sorry, 9,250, 9,575, 9,988, virtually 10,000 and 10,500 are various levels that one can anticipate going forward, right? Now, obviously, that's not going to be straight green candles all the way up there. Some people who watched the webinar done 2 days back, where we had anticipated a slightly higher move, but on Monday the market went down, might be wondering, okay, what happened? Well, that's just the subwave of what could be a 5 subwave pattern for the C2 complete, right? So just keep these levels in mind. Just want to introduce the idea, right? So those levels, 9,250, 9,575, 10,000 and 10,500. So can't rule that out. Besides, we also have the indicators at this point. I wouldn't say favorable in the sense that they're not showing any divergence, they're not showing any weakness, they're not showing any problems at this point, right? There is, however, one completely non-technical news or event that you may want to also consider is the extension of the lockdown, which I think was expected more or less, but you never know how the market reacts, and you can sometimes just have one reaction to that. The reaction, however, might be a short-term temporary blip, and we actually go down before we start to climb back up, right? Having said that, there is clear resistance at these levels right now, which you would definitely want to keep in mind and make sure that the market really does break out of these levels. All right. Okay, I don't need the magnet. Okay. Right. So that level which we'll accurately say in a minute, right? So the high 9,128, so 9,130, let's say 131 here, 9,130, 9,132 is the level to watch out for on the spot. So if this breaks out, then we could easily see a move which makes it easy go to 9,400, and that 9,400 level, right, is there. Okay, I put it there for a reason. Okay, nope. All right. Yeah. All right. So watch for these levels, and this. What color is this? Beige color or whatever. If you just to point out, coincides with an important top, right, of 2015 here, an important top of 2016 there, and that has basically sort of broken out and being tested at this point, right? So sort of 4-year or 5-year support resistance zone, not a very important one, but nevertheless significant enough, because this had 2 year apart, right, these tops. That being broken is definitely, at least in the short term, it is good news. Broke out, being tested, and we'll see interestingly what it does in tomorrow and in the coming week, right? Also to keep in mind, we keep saying the market is always looking for triggers. So all sorts of triggers. The market already has basically decided what it wants to do, but it's looking for triggers. So one trigger which to look forward to, or to keep a watch out for rather, more than looking forward to it, is what the government might announce as further packages, relief measures, or whatever financial packages, etc. The Prime Minister today in his talk did mention that some announcements will be made. So, well, watch out for that, and that might be some trigger for the market to go either up or down. Right? On the way down, if the market does decide to go down, on the other hand, there are multiple levels that one needs to really watch out for, and one really important one is there at what 8,750 basically, right? So at 8,750, this level is definitely something to keep a keen eye on. It closed there, right? You've had the high there, you've had sort of there where again the close was, where the body is, and that's also where the close is. So 8,750 will be another important pivot zone for the market. Watch out for that. And after that, this would also be another important level, right? And that's 8,400. So any of these levels are places where obviously some of you are trading. Good entries and exits with LRS, low risk setups, are quite possible, right? So watch out for these levels, and like I said, watch out for these Fibonacci levels that I've already mentioned, right? So with that, let's get into the individual sector indices and see what the indices are doing. Some obviously will be better than the others. Let's look at that. Before that, a quick look at the broad market in terms of the Nifty 500, and more or less that's just a copy of the Nifty itself. So really the broad market and the narrow market are in track and in sync with each other. Really nothing much more to say on that. All right. So with that, we jump into the first sector index, which is the Bank Nifty, right? And here, when you look at the Bank Nifty, really interesting is, first of all, the clear underperformance of the Bank Nifty vis-a-vis the Nifty. So very quickly to what I mean by that, the Nifty has clearly gone higher, right? It broke this high, has continued to rise higher, but the Bank Nifty is actually making a lower top at this point, right? So banks overall are definitely underperforming. The financial sector obviously has been perhaps one of the hardest hit sectors. If you look at especially the NBFCs, some are down 60-70%, some even more, and some NBFCs had failed before this crash had even happened. Right. So this is definitely the banks and the financial institutions doing quite badly. And with the extended lockdown happening, more defaults, more NPAs, etc., in spite of whatever the government might propose as waivers, is really not going to make too much of a substantial difference, at least not from the announcements that have been made so far. Also, the other thing to note, these highs of 2015, 2016 that we spoke about in the Nifty, those have been broken out of as far as the bank Nifty is concerned. Right. So the bank Nifty definitely doing worse. As a matter of fact, one could, though not the best of triangles, it's really a stretch, right? But it could be doing exactly that, forming a really narrow, very sharply constricting triangle. So if you go by this, then the bank Nifty should perhaps really go down, make another 1, 2, a down move, an up move, and then we'll have to see what the next move of the bank Nifty could be, right? 20,000 psychological mark, clearly going to be a resistance. Again, 21,000, and on the way down, 18,000 has become a place to look out for. So probably range bound between 17,500, 18,000 to 20,000 is what the bank Nifty is likely to do at this point. It can, of course, break out from here, and then if it does that, then I think at least 21,000, 21,500 is a possibility. Okay. Talking about that, okay, yeah, all right. So that's the bank Nifty for you, clearly underperforming the Nifty itself. Then looking at the energy side, right? This I would definitely say is doing way better than the Nifty itself, right? In terms of how it has gone up from about 9,800 all the way to 12,000, seems to be really something up its sleeve. Again, broke down through these 2014, 15, 17 levels, and then has been able to come back on the weekly chart. So one more sector that is definitely doing good, or rather better, in terms of performance, relative performance compared to the Nifty, would be the uh, uh, energy sector. Now, just some pointers for you. So if you see here, we've got moving average here. Really doesn't matter. We've got these 1, 2, 3 shorter term moving averages, which are I've used Fibonacci moving averages 8, 13, 21, etc. So this is the 21 exponential moving average here. You can use whatever you like. And if you look at the energy sector, that's definitely broken way above the 21-day moving average. So that's another pointer to a better performance on the energy side. Topped out at a psychological number of 12,000, poised back, or rather retraced a little bit on Monday, and then we'll see how this moves. And it could definitely move up another 500, 600 points to maybe the 50-day exponential moving average or thereabouts. So one sector that is the reason for the Nifty to do, usually the bank Nifty and the Nifty are very closely correlated. One reason why the Nifty has definitely done better than the bank Nifty, or rather, or the Nifty is doing better than the bank Nifty, is because the energy sector is providing the power or the push, which the bank Nifty is not providing right now. In terms of Elliot Wave, I think those who are so into Elliot Wave will probably agree that this is looks like a clear, 535 pattern, right? It's a little hard to see the subwaves here, but just a possible labeling is that's the A, that's the B, and then you have the 1, 2, 3, maybe 4, and then the 5 of the C that needs to happen, right? So that's something to watch out for as far as the energy side is concerned. Coming to FMCG, what a fantastic pullback, right? Just going to zoom out all the way, right? This is the weekly chart of the FMCG all the way from 2012. Unfortunately, this index data is only from then. But anyhow, as you can see, what again, something that always makes me, I still haven't gotten over this thing. I sometimes get goosebumps. How it came here exactly, right? And if you had been tracking this level and marked it 23,000, which was the high of 2015, a double top of 2015, 2016, and some bit of pivoting around that price in 2017, it just touches it, and then it just bounces from there, and 23,000 and back to 29,000. That is a massive recovery. You probably had just one day of opportunity. Yes, there you go. Right, just one day, and that to an intraday opportunity, which probably lasted, I don't know, I'm guessing maybe uh, half a minute, maybe 2 minutes, maybe okay, maybe even half an hour or 1 hour, but that's it. You had that one day, and then after 2 days, you had another move down, and then it just moved back up. So this old green line is the old multi-year top. It's not the fresh one, and massive, return back, and stuck right now, or rather paused, not stuck, at the 200-day moving average of the FMCG index, right? So effectively has done a very, very nice bounce. All the stuff as far as indicator studies are concerned are very healthy, right? One of the few indices where even the MACD has gone into the plus territory. It's 54, right? And it's gone above the zero mark for it, right? Not many indices have been able to do that. As far as the NSE is concerned, the MACD is at minus 495. If you look at the MACD for the FMCG, it is plus 54. So that's a fantastic recovery from being at minus 1,500, right? So, for all some of these stocks are just going to go back and make new life highs. Of course, some FMCG stocks have already done that. It would be quite amazing to see some of the FMCG stocks actually making new life highs in the last 3 days, while the rest of the market has just gone bonkers, right? So two things about FMCG. One is the usual defensive play when markets are bad. Two sectors which are generally the defensive play when markets really go bad are consumables, the fast-moving consumer goods, shampoos, soaps, toothpaste, the essentials. FMCG definitely that, and the other one is pharma. Right? So one reason could be that. The other reason is, well, so one is essentials, the other one is the defensive play. Quite interesting in the sense that I really don't know how consumption would go up. If you try and find any fundamental reasons for it, at least I can't. If you have any fundamental reasons why this should do so well, then please let me know, because the buying, selling of the products will basically be at the same level. Of course, there might be some hoarding that's happening, but then that just depresses demand later, right? But anyhow, technicals is technicals. Let's not dwell too much in trying to figure out connections between technicals and fundamentals. Anyhow, right? So this is a great recovery, actually, on good volumes also, right? It's come up on pretty good volumes. The thing to watch out for in the short term would be this downtrend line. And even if I want some more points, right? does it break out of that or not? So that's around say 30,000, and if 30,000 breaks, then I think another 10% upside to 33,000 on the FMCG side is quite possible. So the apart from now energy, you also have FMCG, which is definitely providing tremendous upside support to the Nifty. Some comments. Okay, Ravi is saying that he thinks that the market perhaps is thinking that other sectors will not do so good and bet more on the FMCG place. Yes, absolutely, quite possible. Santosh is saying smaller FMCG players are getting squeezed, so larger listed players are getting consolidated demand. He's asking that as a question. Quite possible. There is an article, I'm not sure where, but today only, there's an article about how private labels and local labels are actually now doing much better than branded FMCG products. So private labels are where the supermarkets package their own stuff, put their own internal label and do it. So everybody does it. Reliance Retail does it, More does it, all the supermarkets, even Metro Cash and Carry does it. So especially your wheat, your dals, your salt, and all that stuff, which are really is what's the big deal with branding in that. Those private labels are actually doing very well. And the point that was made in that article is that the large FMCG players are having a big disadvantage right now because logistics has basically come to a standstill, right? It's really difficult to know what the truth is, but I'm not sure how many trucks are flying around. There was an article about a week or 10 days back about the Ministry of Transport suggesting that they waive toll on the highways because one, just to make things easier. I don't know where that logic is, but also because traffic has fallen drastically by some 50 to 70%. So leaving aside the passenger traffic, I'm thinking that a lot of manufacturing supply chain traffic has also substantially come down. A lot of news about farmers in distress because while they are harvesting, they're not able to get their stuff to market, especially the vegetables and perishable items. So even coming to other things, not sure about the branded FMCG guys being able to get their stuff across to the stores. Also, anecdote from Alok, who had gone to MK Retail of Indranagar today and said, well, the shelves are basically empty. Well, if anybody does visit any stores, please take a few snaps, at least the large stores, not the local mom and pop ones, not the Kirana ones, but if you go to any of the large branded ones, MK Retail, Reliance, More and all, just a few snaps, from various locations to get a sense of how the stock is in places. Of course, can't generalize, but it will give some sense. So Santosh's question about smaller FMCG getting squeezed and the bigger ones getting consolidated, maybe possible. Can't rule that out. Definitely in tough times, the big guys have the money, have the logistics, have the connections, have the ability to actually take advantage of tough times. So yes, I think there is a possibility there. All right. So FMCG definitely to be looked at very seriously, right? In terms of opportunities on the buy side. Of course, I think some really good ones have been lost, but again, we'll come back to that later. All right. So that's the yes. Ravi is asking a question in terms of Elliot Wave analysis for the FMCG. Well, that's really a good one and a tough one. So if I, to just make it as simple as is possible, then that's clearly, wave one, and then we've got wave two, right? Very short wave two, if that is a wave two, and then three. So let's see how that did and get a sense of that's one. And we are talking about that, right? So at 1.618, wave three has definitely reached that, right? So wave 3, even if you say 1, 2, 3, 4, 5, right? Again, if this is a correction or is this an impulse? Is this an impulse? That's I think a really good question to ask. 1 second, let me just clarify. Ravi, are you asking fifth wave upside like that, or you're talking about the fifth wave down of the big crash that's already happened? Just to be sure we are on this. Okay, upside, right. So 1.618 has been accomplished. The thing about that 1.618 is, let me just move it aside, is whether those internal 5 subwaves are there. It might be there 1, 2, 3, 4, 5. Yeah, it could be that, right? So you could have, if this is the bottom of the 2, and that is starting of the 3. So 1, 2, 3, 4, 5. Right. Let's actually do another extension and see how that pans out. We'll take that, and put it there. All right. So nice. It comes to that 78.6. Usually 61.8. 61.8 is where it closed. 78.6 is possible. 100 is also possible. But yeah, looks like 5 of 3 is over, right? So I would think that, let me just start again. So wave 3 is over, wave 4 is going on of a higher degree, and then maybe a 5 is left, right? Are you with me? All right. Anybody else who did the Elliot Wave course? Any questions? Yep. All right. So yeah. So I think there's a possibility that we have 5 happening. I mean, rather 4 happening, and then a 5 could happen, and who knows where that could go in terms of, it could just go back to 31,000, or are we looking at perhaps even life highs, right? All right. Santosh is talking about HUL. You talk about individual stocks in a separate webinar, but he makes a point to say the crash was a wave 4 and the rise was a diagonal of shorts. Okay, possible. All right. So FMCG, clearly a lot of levels to look out for, and let's mark those levels. So like we said, about 30,000 is possible. That's where the 5 may stop. And if we take this and extend sorry, right, so somewhere 30 to 31,000, I think there is definitely some resistance there. On the weekly format, okay, after the recovery, we have still to see the MACD crossover, which has not yet happened, right? But that's going to be a long time off. Uh, really, if waiting for it is not going to help. But on the weekly side, as you can see, you've got 1, 2, 3 solid weeks of gains, and now you've just got, of course, it's only Monday, and you've got just this teeny weeny little bit of pause or correction of these gains. Who knows, we may come back to even 25, 26,000 and then rise again, right? So essentially we had about 2 years of consolidation here, 1.5, 2 years of consolidation from mid 2018 till the end of 2020. Then we had this correction, and then we seem to be going back up. And what's really fascinating is even this volume that you see, really tremendous volume on the green stick, and continue. Okay, it's faltering right now, but this is really impressive, something to be kept in mind. So FMCG is the place where you want your money to be, right? Probably the one index that has performed the absolute best, but we'll wait on that, right? Why do I say that? Because it also came back to the 200-day moving average, took a pause, and then is looking most bullish than anything else that we've seen so far. Of course, not everything has been done. All right, so that's the FMCG, some upside left on that. Then coming to infra, well, you can clearly see, I mean, the contrast. I'm just going to switch the screens. I'm going to go back to FMCG. Just look how impressive the recovery is, and look at infra, how dismal the recovery is. Right, really not doing well at all. Has managed to break through the 21-day moving average, but not much. And of course, unlike the Nifty, where it's topped out at at a certain level, this has continued to make higher highs, higher closes, and all that. Uh, okay, in terms of weekly, it's coming to important resistance zone, all this thing here at around 2600 to 2700. You can see it's a pretty crowded chart, right? In terms of almost 10 years of data that you see on this infra, basically it's gone sideways, right? This is not a chart which has trended up or down for a good decade. So much for infra investing, infra spending, and all of that. Maybe if you are a contractor or building roads and all that, you make money, but clearly investing in infra. Just to remind that, at one point, infra investing was a popular theme in the media. Infrastructure related mutual funds were launched left, right, and center. But if you look at the evidence, being a pretty sad state of affairs. Right? So more or less range bound, and I really don't know whether infra is ever going to break out of 3,500, 3,700 in the months or years ahead. If it does, that will really be an outstanding achievement. In the meantime, more for discussion than anything else, a great opportunity was when it came to 2200. That was a 8-9 year support level, and has taken off from there. But of course, if you're doing sectoral comparisons, then yes, you would have made money. 2,200 to 2,500 is a good 15%, which is very healthy in a market that's fallen 30-40%. But all said and done, there are and were better opportunities available. So nothing much more to say. Infra, it's coming to a congestion zone, 2,600 to 2,700, and there wouldn't really be anything significant. So you probably more stay out of infra rather than get into infra. Coming to IT, right? So IT index, so one of those indices which has the most data available. IT index had the dubious. Okay, let me just. It's a bit crowded, I know. Sorry about that. These are all some long-term studies which I had marked. I hope it's a little clearer. Right. 1999, 2000 .com boom came, and that level was only crossed in 2014. So a good 15 years, 1.5 decades it took for the IT index overall. Individual stocks did better, worse. Some have still not gone back, right? And then it's continued to rally. So coming to the last 5 years, and all right, so we had a nice move there from 2017 to now to reach about 17,000, almost, no, 16,900, and then it just come crashing down. In terms of daily charts, so this was a pretty significant crack, right? From 17,000 almost to 11,000, that's 6,000 gone. One would have expected IT to do better, but it did not. And the one saving grace for IT, or rather multiple saving graces for IT, but it's a really mixed bag, is one, the rupee has broken the 72.50 mark about 3 weeks back. That was a huge significant breakout that happened. So if any of you were tracking the rupee chart, it was really something to witness, because in hours it went to 74, 75, and then next day went to 76, came back, cooled off. It just disrupted, or not disrupted, but the speed at which the rupee devalued was astounding. So that basically is obviously healthy for the IT fellows, right? So that is something to keep in mind. But most IT companies do tend to have some sort of a hedging policy on their revenues. So really nothing to particularly write home about on that. So they would have locked in a certain rate for conversion, and they're not going to be able to really get out of that without paying a penalty. But future contracts could be more lucrative. But on the other hand, with the fact that globally we have this recession of a century, everybody's going to want lower prices. There's really no doubt about it. And all your customers are also as savvy as you are, and they say, hello boss, your rupee cost is the same, and in dollar terms it's become cheaper. You need to pass on those savings in dollars to us, so you need to reduce your billing and your rates. Anyhow, most companies are going to postpone unnecessary stuff. So I'm not sure. Of course, IT is critical in some sense, but in many other ways, there are a lot of things in IT that one can just be pushed and for weeks, months, years, perhaps. There was wonderful news about some of the American states running their IT infrastructure on 1960s, 1970s mainframes requiring COBOL programming. And some of those state mainframes were actually crashing and not able to handle the load of the unemployment benefits, because that's all processed on mainframes running COBOL. And suddenly there's this demand for COBOL programmers, and you hardly find any. Most of them are probably, who knows, in the 50s or 60s or 70s. But well, if you're a COBOL programmer and you're willing to offer your services, I think you're going to get top dollar and more for at least a few months. You could probably make 2 years of income in maybe 6 months there. So think about it, Google it if you know COBOL and want to, take off on a vacation to the US. Not sure you want to do that with their healthcare system really in a pathetic state, but anyhow. All right, ask your employer to bundle in health insurance with that. All right, so anyhow, IT has come back down, and unlike the other sectors that we saw, has not yet been able to break beyond the 2015 top that is made. And as a matter of fact, could even be said that it is seems to be a little stuck there right now. Now, having said that, are we looking at a possible ascending triangle, right? Which we could be. You have, a sort of a tweezers top there, and this would be a really sharp ascending triangle. You've got a high there of 12,950. I think that's high of 12,930. This high is at 12,897, 900, and that's a little side at 12,870, right? So 12,900 for all practical purposes, 12,900, 12,950, say 13,000. If this breaks, right, then the IT index is poised to go up quite significantly if this can be construed as a rising, ascending triangle, which it really looks like, right? And also, only downside, the volumes are really lagging, right? Really nothing much on the indicators, except there's no divergence as or any particular weakness, but the volumes are definitely not there like they were there in some of the other indices. So IT somewhere, uh, in one sense a surprise, in other sense could be quite an opportunity in the coming week or weeks ahead. So if you look at this again, it may just have one more small day of down move, maybe 50, 200 points. How much is that? Yeah, about 200 points, and then we start seeing green again, and then it really moves up. And this level, which is at around 12,250, 12,300, is definitely a level to watch out for in case it comes down, right? So could be a nice up move if a breakout happens, and then we really see it moving up. If it does break 12,250, however, okay, if it breaks 12,250, then I think we will see very quickly 12,000 and maybe even 11,000 800. You need to keep both possibilities in mind. But really, at the end of it is at the apex of squeeze, and just have to see how the squeeze pans out. Right? While everything looks, sometimes you need to intentionally look for the other side and see, are you missing something? Because it's just one of those human biases. We like to see things going up, right? So please consciously remember both upside and downside levels. If it's upside, then really raised really no resistance for it to make a nice sharp up move to 13,500, maybe even 13,900. Just going back to see, yeah, so that's your level there, which is at 13,500. So at least a good 5%, 6% up move is quite possible on the IT side. All right. What is missing? Reality, all these are sort of duplicates. Okay. Specifically, capital goods, really nothing much. Again, capital goods is your big brother there in that capital goods business is L&T, right? So that's just fallen by more than half. So 21,000 to 10,000 is just cracked. And I'm not sure what capital good stuff is going to happen in the coming few uh, months, maybe years. A lot of idle capacity, a lot of companies that are just going to be, having huge overcapacity. So capital goods is basically new factories, construction, excavators, trucks, lorries, heavy machinery, CNC machines, all that. I don't see where the demand for that is going to come for that right now. So definitely one of those laggard sectors. Really nothing to see there. Could be some value opportunities in the coming months, but nothing immediately to really jump into. But in the coming months, some really great value opportunities will be there in the capital goods space. So after something like the FMCG run up, the and the which was the other sector? Yeah, basically the FMCG run up, and people want to take profits. They could rotate that money and do a sectoral rotation into capital goods in the months ahead. I don't think it's going to happen very quickly right now. But for those of you interested in terms of really great uh, opportunities, long-term investing perhaps, you could definitely look at the capital goods space. So there's been some bounce, but as you can see, I mean, I don't think there's anything more to say. It's been an extremely weak bounce that has happened so far. Looking at reality specifically, well, the story says it all. Still in the daily mode, down in the dumps, it's gone, right? Reality is it's really gone. Any of the realty companies, first of all, 2008, imagine where it was 14,000 in 2008, the realty index, and see where it is, 1,300. 90% erosion of wealth in that realty index, right? Even after 12 years. So long-term wealth destruction, amazing in India. Having said that, it's come to this 6-year level and not very far from a potential long-term support. Of course, that is not the support. 1,000 is the level. So that's another 300 points down, is where the worst so far has been. Nothing to say that it can't go below 1,000, right? What happened? Yeah, that. Nothing to say that it can't go below 1,000. It can go below 1,000, but these are multi-year supports. Again, 100-year event, anything is possible. But there could be some really great opportunities in reality, something to look at. So your infra and reality bottom fishing, not yet, but could be there, maybe 10, 15, 20% lower. Zooming in, really no recovery at all in reality, right? So from 2,500 fell to 1,300, nothing. Uh, it has no breath left. It's almost stupendously breathless lifeless rather, in terms of how this chart is behaving. And every chance it got to get sold off, just it got smashed by the bears. Right? So reality is over, and okay, nothing should be said out, but a long way to go. Specifically, auto making a good show, right? A lot of conflicting conversations, opinions about auto going on. One that a lot of people will buy cars because they will they will shun public transport, and a lot of people will um, want their own transport. A lot of people will want second cars for their families, and definitely those who have been using Ola, Uber, and all these aggregators, a lot of people who were using that were actually IT folks, etc., who could afford it. It was just the convenience that it provided. So they had the money, they just didn't choose to spend it. They might go back. But the counter, or the another perspective, is that a lot of people are now going to be very careful about spending the big bucks on anything, whether it's a car or a house, so unless it's really necessary, or unless you are filthy rich and you have a lot of money, which is not a lot of people right now. Is I'm not sure. I don't know which way that argument cuts. That there will be a tremendous recovery in the buying of vehicles, both two and four wheelers, versus if there is, even if there is a big buying that does happen, I would be careful in terms of extrapolating that buying that comes in, whether that sustains for the long term, or it's just the initial buying that happens by those who can afford it to have their own personal vehicle because they're shunning public transport. Right? Maybe for a few months, suddenly the factories are running 100% to cope with the demand and all that. But other than that, whether it's a sustained recovery, I have my doubts. Right? Also, remember, with multi-million job losses that are definitely going to happen, definitely a lot of those job losses are going to be in the middle class folks, management level folks, software guys, manufacturing guys, a lot of that. So defaults on housing loans, car loans, etc. There's going to be a certain fear in the public mind, and spending money is really not going to be easy, even if you have it. Having said that, came to a 2010 level. So basically 10-year drop. So from 27,000 to 10,000. So this is the worst uh, fall perhaps compared to all the indices. But to be fair, 27,000 happened in 2018, right? And 10,000 happened here. If you look at the fall for this year, well, it's from 18,000 to 10,000. So that's 8,000 points, right? So that's still about almost 50%, about 40%. But this is huge that we have a situation, and this really tells you how bad the economy has been even before the coronavirus, right? Slowing vehicle sales, slowing passenger and truck sales, which has been going on. You could say, well, this is not, of course, sales data or revenue data, but for at least a good 1 to 1.5 years before COVID, the economy was definitely in a bad shape because the auto index itself had gone from 27,000 to 18,000 or even 15,000. So that was itself a 50% cut that you saw in the auto index in the last 1.5 years. So whatever the reason, and that just been compounded, right? Okay. Some particular news items. Mahindra and Mahindra saying we will not be putting more money into Sasyong. I hope that's how you pronounce it. Their South Korean subsidiary. So that company is going to be selling a minority stake to raise funds to survive. Tata has decided to get into a joint venture with a Chinese car maker for electric vehicles, and they're going to stop reporting monthly sales figures. Of course, they're giving it a nice corporate, ring to it, but there's a lot of just pain, a lot of BS 4 compliant stocks which have not been sold by the two-wheeler companies. Not all. I think it is Hero Honda, TVS, but Bajaj sold a lot. And that BS6 deadline, whether the government will change it. Supreme Court refused to, but whether the government will maybe change the rules and the laws, you never know. So there's a lot of this backlog stuck. There's a lot of supply chain blockages, a lot of inventory which is blocked, and what happens to that? So which company, or rather, who in the supply chain absorbs those losses? Uh, Having said that, is there some opportunity in the auto space? There could be. I mean, you're talking about a 10-year low of the auto index, and the only thing is, really nothing on the indicator side to say that the worst is over, except that we've got the biggest mega sold level that has ever happened on this indicator, which in itself may be something to think about, right? So that's the thing is, you'll always only know in retrospect, but if it comes back to 10,000 levels, the auto index, there might be some buying opportunities which are there, right? Great. So okay, metal index. Right, metal index is, well, it has broken, I think, the worst index now, right? If you look at this, it's come back not close to, but almost to its 2008 levels. Again, one of those indices, apart from infra and realty, which never came back to 2008 levels and unlikely to for a long time, right? So these are, in a sense, maybe just dead cat bounces which are there, and they need to really go lower. I don't know, right? But watch out for further leg downs if on these really long-term indices. If you're talking about, so Barclays, by the way, came out with a report today, which some of you may have seen, that there will be 0% GDP growth for India this year. And I think that was announced after the lockdown extension. So basically about 5-6 weeks of almost zero economic activity. How do you recover from that? If you just prorata it, that's 8.5% of annual production gone in 6 weeks, right? 8 to 10%. It's really tough to recover from losses like that. So anyhow, coming to metals, huge fall. Again, probably some fantastic value opportunities at lower levels. Those looking at building some very long-term portfolios might want to look at specific stocks in the metal space, in the auto space, in the infra space, in the realty space, and the capital goods space. But those who are into trading, then at least on the long side, you've got pharma, you've got where is that? Right. You've got pharma, you've got energy, right? Pharma just looks out mouth-wateringly good, right? And FMCG, basically, right? All right, so that's it. So just to wrap up, essentially all the stuff that we're talking about bullish is for the short term. Like I pointed out, further pains expected on the downside, and so any upside move that is there should be used either to just trade or get out of any spot holdings that you might be having. Of course, individual stocks, the story might be very different. Pharma, for example, there are some fantastic moves in the individual pharma stocks there, right? Yes, Madhu, we finished pharma, right? Okay, so overall, short term, use the upside for maybe going long, but like we discussed, especially Elliot Wave wise, it's possibly just a pullback rally, and then we are going to see another fall Starting when? That's the tough question, but probably in the next few weeks. It could be an extended, slower fall this time, not as much as what happened uh, in the last one and a half months. So basically, definitely not the time to be building a portfolio, except maybe in specific sectors. Uh, Using the rise to prepare for shorting and at least some short-term trading long side, and then there's a lot more action to come. To end, if anyone has done any comparative studies between the 1929 30 34 crash in the US and the current one, please do let me know. Of course, we're not talking about Indian data now, we're talking about US data, but there might be some really useful insights to be had from that analysis and comparison. Right? All right, so done. I hope it's been insightful. It's been quite interesting, actually. My mind spinning. A lot of very contrasting setups and opportunities that are there in the market right now. Right. Uh, Done. So thank you very much. We'll have the recording up as soon as possible. It's going to take a few hours, so might be uploaded maybe much later in the evening. Today I will announce it on the WhatsApp groups. Right. Any questions before we shut down very quickly? I don't think they are, but just in case, what we wanted to do was the sectoral indices and the Nifty review. We've done that. Just to remind everyone, please subscribe to the channel. Forward the IMRs that I'm doing, that I started day before this one, and the next few will all be free. Feel free to share the links with whoever you want. Forward them to whoever you think might benefit from it or might find it useful. And let's see where it goes. Right. So with that, thank you very much. Have a good evening, and I'll catch you in the next webinar. Bye.
Bye.